So, welcome to another edition of Family Office Real Estate Insights. I'm DJ Van Keuren, and today I have Scott Snow with Provision, which is a tax firm. Scott, thanks for being on the show today.
Yeah, no problem, DJ. Enjoy having me here.
So, we were talking a little bit earlier, and you were talking about some of the various tax strategies that you all work on, you and your firm, as well as, some of the different real estate tax planning as well. What's the biggest mistake that you see, first off, when a client comes in, when it comes to tax and their real estate?
The biggest one probably is just education. They just don't know what they don't know. I mean, just understanding, the Internal Revenue Code a little bit and understanding what deductions are allowed for them, and just being able to take advantage of all those things. It's usually just not, the idea, everybody kind of knows that, hey, I want to build my wealth. Real estate's a good way to do it. It's a hard asset. It's going to go up in value. I'm going to collect my rents and, short-term or long-term, and I'm going to make that happen. And also I'm going to get some tax benefits. But they don't often know really what that means. It's like, what does tax benefits mean? And do they even qualify for some of those? If they got a full-time job, it may just be a passive investment and really not help them tax-wise. So it's just really just the understanding and the education that they don't have. They understand real estate, but they just don't. Sometimes it doesn't correlate to what the tax brackets are. Because we see it all the time. Someone that comes in and they buy a piece of real estate, hey, this is going to save you a whole bunch of taxes. And when they get down to it, and they realize that, hey, it's not really saving them a lot of taxes. They still maybe growing their wealth, by the property going up in value and the rents. But from a tax perspective, unless they meet some certain criteria, it may not benefit them. And that's usually the biggest surprise that most of our clients face. They just don't know what they don't know. And that education is what we specialize in.
But is that based on the properties that they own, or investing as passive investors, or both?
Both.
And how often do you see on the passive investments that the sponsor or the operator that's running the deal, that they don't pass through all the depreciation benefits to their investors? Do you see that happen a lot, or not really?
Not really. You don't see it a lot. Most of that's kind of the enticement to get into like a syndication type deal, is that there's going to be some passive loss or something that's going to be passed forward to you that's going to be entice the investor to make that investment. Not only there's value increase and those type of things, but really a lot of those syndications, one of the things they propose is, hey, we're going to be able to pass on some of these depreciation and deductions to you that you then could be, depending on your situation, be able to write off on your taxes and save you some tax money. So that's usually a big one of the big selling points. A lot of those syndications is that way. So you see that fairly often to do with pass through. Not very often we see one where someone would get into it and not get those kind of deductions, but that'd be unusual.
Got you. So what are some of the, you're saying, we were talking a little bit before about some of the areas that you need to educate, a client on. Mm-hmm. Could you get a little bit specific? I would imagine that if they're owning, like one, for example, might be not utilizing cost segregation.
That's one. Yeah. Depreciation. Big one. That's a big one.
Okay.
The other one that probably gets most people is just the passive versus active, right? Mm-hmm. Is this active income or is it passive income? And as you know, the IRS says, hey, rental income is by nature passive. And so having passive income, depending on your tax situation, you may want other passive losses to help offset some of the passive income you have. But if you have only passive losses, understanding that those losses are not deductible, they roll forward into the next year. You don't get a current deduction for those passive losses. Depending on your situation, there are times where you may get a little of them. But just understanding that passive versus active is one of the biggest ones that we see, DJ, that they just don't really understand, how this is going to help you. But when you said cost segregation is another big one. But again, those two kind of work hand in hand, right? I do a big cost segregation. I'm going to get all this extra depreciation, which I'm writing off my property faster. But if it's all passive and I don't get those extra losses, I've just got this extra depreciation to carry forward. And so it can be really a disappointment to some clients when they come to us and they say, I've done these cost segregations, I'm going to save a bunch of money, when they realize, hey, it's all passive losses and those losses get suspended and carried forward. So you see
But
that, or people get confused on.
but you can still, as long as it's accumulating, you could still use it down the road, correct?
Right. You don't lose it. It just gets carried forward. It just doesn't help you currently. Those passive losses carry forward until you either have passive income to offset it or you sell the property. In the year of sale, any passive losses associated with that property are 100% written off. So you're right. You don't lose them, but if you think about a cost segregation, if I spend money to do a cost segregation, I got to outlay cash to get that. I'm hoping that I get those tax savings to help offset some of that cost. And if I outlay that money and then I don't save those taxes, clients get a little disappointed. They say, oh, dang it, I didn't get that money. I didn't get that. Yeah, I get it down the road some point, but I don't get it currently. And that's what gets frustrating for a lot of clients.
So, and can you use some, as they accumulate, can you use some of those accumulated losses to offset, uh, ordinary income or cap gains?
You can in certain situations, right? The term they use a lot is that term real estate professional.
Mm-hmm.
You have to qualify as a real estate professional, and the IRS has specific rules on how you qualify for that. And if you do qualify that, what that does is that makes your real estate losses not passive anymore. They become active. In that case, those losses then could offset against my W-2 or my business income from other business cap gain income or other things. So you can get that deduction, but again, you have to meet that qualification, which is pretty hard. It's pretty stringent to meet that our real estate professional qualification to get those deductions. But if you don't meet that qualification, in that case, you offset passive income with passive losses. And if your losses exceed, those losses get suspended. They call it, get carried forward into the next year until you either have passive income or, as I mentioned, you sell the property, in which case then you get the full deduction.
What would you say, what percentage of the clients you work with utilize 1031 exchanges?
A lot. A lot of our clients do 1031 exchanges. It really depends on the market. As you know, the markets ebb and flow. In those years when the market went down in the early 2010, those days, you didn't see a 1031 exchanges because a lot of properties were at a loss, right? But now in the last several years, where the properties have come back in value, I know here in Arizona and around the country, property values are up. They're kind of even right now here. It kind of leveled out a little bit and even got down a little bit in the last 6-8 months. But you see a lot of those properties that are doing 1031 exchanges. So they're rolling that gain and not paying the tax and rolling that gain into the next property and avoiding the capital gains tax. Smart deal to do.
Yeah, we do the largest family office real estate investing study. We're on our 6th year, and consistently 80% of families haven't done on 1031.
Really? Yeah. We educate our clients on the options to do that when they're trying to sell. All the time there's some specific rules they have to kind of meet to get that to do one exchange, and sometimes they find that a little prohibitive. But ideally, they could do that in a way. I said, what's that term? The 1031 exchange till you die, right? So you just keep deferring the gain, and eventually you die, and your heirs get a stepped up basis to the value of date of death, and no one pays tax on that gain. It's a beautiful concept. But yeah, we encourage our clients to do it anytime they can, unless, like I said, the challenge is that if they're taking a property and they're selling it for, could be a lot of reasons they're trying to sell that property, underperforming, or they just want to get out, whatever. It's finding another property, because you got to go, real property for real property. So you have to find another one that is going to do that, and it's going to get you what you're looking for. One of the things is, we were talking earlier about those passive losses. See, passive losses are freed up in the year of sale if it's what they call a taxable sale. A 1031 exchange is not a taxable sale. So if you roll that passive loss, you got to think about, okay, what's that going to do in a 1031 exchange? Maybe I have enough losses to offset my gain, right? I've carried forward. And if I don't, then a 1031 exchange makes a lot of sense. And we encourage our clients to do it as much as we can, because, like I said, unless there are reasons to not do it, if they need the cash for other reasons and they just need to get out. But yeah, if they can avoid the tax, we certainly want to try that as best we can.
What are your thoughts about, 721 exchanges are starting to become more utilized, where properties are being contributed into a REIT, for example.
Right.
Have you seen an uptick in that, or and what is your take on that type of structure?
Not seen, what we're doing. I'm not seeing a large uptick in that. Certainly, there can be tax advantages to doing it, making that exchange. But again, you just got to look at everybody's certain situation and see what that looks like. I have not seen a lot of them, to be honest with you. Most people are going to do a 1031 exchange, is where I've seen mostly what people are doing. Or they're doing it in some kind of syndication deal where they're trying to do the syndicator and set up a deal to get investors and do that. That's where we see a lot of those things. Just buy and hold, short-term rentals, and then the syndication. Syndications are great because if you're an investor, they don't take a lot of time, right? So I can get syndication. I do my due diligence on the front end. I don't have to manage the real estate and manage the rentals and do all that stuff. I can invest the money, get some deduction and get on. So we're seeing a lot of that, but like I said, not 721's not seeing a lot of those yet.
What are your takes? It looks like opportunity zones are going to sort of come back into favor just because of that, the capital gains benefits that were gone, right? What have been your thought? Do you think that the opportunity zones have gone the way that they were projected or supposed to?
That's a good question. And I know in the new bill, there's some updates in that as well. I know the bill that's in the Senate right now that's going through, there's some update in the opportunity zone, trying to make them a little more attractive. That's one of the things they were going to renew. Now, it hasn't passed, obviously, yet, but I know that's part of it, what they'd like to get in there. In my experience, they're a little bit of an overhyping, just in my experience. The problem with them is the idea is a great idea. I can defer the tax. I hold it long term. I can avoid the tax. If I hold it long term, I invest there. The problem is a lot of those investments, the rate of return was just very small, right? I mean, I know some guys got into one at 1%, 1.5% rate of return. It's just very small. Yeah, I'm deferring the tax, which is a great idea. But with that kind of rate of return, would I be better to not do that and do an investment at 10 or 15%, even though I got to pay the tax? And so that was always the crutch of people's making that decision. I would have hoped, the clients that I got into, they were hoping that, man, if they can defer the tax and get a good rate of return, man, that would be a win, right? That would be just fantastic. But and the ones that I've seen, the gains were just not up to where I wanted them to be. And that's what was always causing that decision-making, that challenge. Because if, rates of return are 10, 15%, it's a no-brainer. You do it every time. But when the rate of return is 2% or 1.5%, just made it tough.
It's the time value of money, right? So the further out that it goes, and why people weren't stabilizing and sell, I don't know why, because that would enhance returns.
Right.
And I actually think that one of the best uses of those were businesses or actually VCs, which could really maximize that.
Right.
So what type of things, what type of things do you look for, or do you think is often missed out? And I know we talked about this a little bit already when it comes to, their real estate investments and the tax benefits. I mean, you have the opportunity zones, obviously, the 721s, the 1031s, cost segregation, which is a very big part of that.
Huge.
What about deductions? Why don't you explain a little bit when somebody has a low basis in a property, right? So they bought it 20, 30 years ago.
Right.
And let's say whatever that price is, it's down to 10% of the value of the building.
Right. Small.
Yeah. How does that impact those people that own those properties?
It's because you're not your biggest deduction. And a lot of those properties, like you said, if they've owned 20, 30 years, there's probably no loan anymore. There may or may not be a loan. So there's not any interest deduction. The depreciation now is small. If they got anything, we're going to be running out. If it's a single family home that goes 27 and a half years, they may be out of depreciation completely. At that point, you look and say, okay, is it still, I'm getting from a tax perspective, I know a lot of times you see the tax benefits are great in the front end and the income is kind of steady. So the deductions may be higher than my income at first, but then as the property gets older and older, that starts to switch. And now my deductions lower, my income's higher. So you got to decide, okay, is this the time to 1031 exchange into a higher value property, right? I can roll up into a bigger property. I can take it. I have this, it's free and clear. Maybe at this point I have low deduction. I can take that large gain. Maybe it's, especially if I've owned it 30 years, it's gone up substantially in value since I bought it 30 years ago. And now I have this huge gain. Can I roll that gain into maybe a bigger property, multifamily, something like that? Can I roll it into something bigger? So now, one, I'm going to get a higher base. I'm going to get more deductions. I'm going to get into those things, which allows me to get more deductions on the way and expand, right? I'm making my empire bigger. I'm taking this property and I'm now going into a bigger property and expanding my wealth that way. Other than that, you're looking at just making sure that you continue to take care of all the small deductions, your home office deduction, your vehicle. Are you doing rehab on work and you pay your kids to help you do that? Are there different things you can do to lower your tax situation with that property, even though it may be low in depreciation and not much interest? I mean, there are some other things. We just want to make sure we're taking advantage of even some of those smaller ones to just try to maximize all the tax sections we get on the table.
Yeah, because that with a lot, when I was bringing up those percentages before with families, a lot of that is because it's their legacy assets, right? And they want to hold on to it. There's some an emotional component to it, right? Which can be good and bad.
Yep. And other thing to do on that case, because at that point you start to have a lot of passive income. Okay, right. Maybe I buy another property that's going to have some losses. Again, that'll be passive losses. I can net those two together. So what I've done is I've expanded and I've still avoided the tax in that one that's now high cash flow, high income, because I don't have many deductions anymore. And I've expanded to another property. Now I can use those passive losses to offset some of that. And I can continue to do that, expand and use those losses and keep avoiding the taxes as I move down the road. So oftentimes expansion at that point, buying another asset that has depreciation, syndication, something like that, which is going to kick off some type of passive losses, that then could offset some of that passive income and save you some of that tax.
Yeah, I mean, real estate is the second largest area of wealth creation for families that created their wealth in other industries. And for many of the reasons that you're talking about, I think that a lot, and you tell me, but I do think a lot of those tax benefits do get overlooked.
Yeah, they do. They do a lot. And I couldn't agree with you more. I have a lot of clients that I grew up in Idaho. So I had a CPA practice there for 13 years, did a lot of farmers. And those farmers did okay. But where they made their money is when they retired, they sold their land, right? I mean, that's where what made them wealthy. I mean, they did okay and they made money on the farm and doing that when there was a cattle farmer, dairy or crop farming. But all of a sudden, as towns have been expanding, if those properties were close to town, now all of a sudden that land's worth a lot more money when they sold the land. That's where they made all their wealth, really, was tied up in this land, which, you think about that, that's kind of counterintuitive. You think, oh, I'm making this money, I'm raising cows. Yeah, it's great. But, that's where they made their generational wealth, is from the sale of the land when they get ready to retire. A lot of it might have been that.
And there's a lot of farmland that is out there for sure.
That's right.
As we go forward. Any last thoughts or comments that you'd think would be the takeaway for that people should, when it comes down to tax and benefits and everything, that is extremely important that you would, make sure that every single person knew?
Number one, hire a professional. Right. So they say sometimes the most expensive words in the English language are do it yourself. Right. So, having a CPA on your team, helping you navigate the deductions, make sure you're taking care of all the deductions you can get. Right. You don't want to leave deductions on the table. I have clients that say, well, I don't need those deductions because it's passive losses and I won't get the deduction this year. That's true. But as you mentioned earlier, I get to carry that loss forward. At some point, I'm going to get the deduction. So leaving those deductions on the table, I'm just leaving money that I could get at some point on the table that I'm never going to get if I don't take that deduction. So, getting competent help, that's the big thing. Educating yourself, get a good CPA, hire someone that knows what they're doing. They can look at your system. Do you have the right entities in place? LLCs, or find out what state you're in, what you're doing from a liability protection, getting with your attorney to make sure you have all that right stuff. And just like I said, doing it yourself through TurboTax is great. It's cheap and it's inexpensive. But in the long run, what does that cost you? What is the opportunity cost you're missing out on if you're missing those deductions? So just get with a CPA. If you haven't already, great. Meet with them, go through your stuff. Make sure you're taking advantage of all the deductions that are possible for you. Because that's what you don't want to leave anything on the table. Because in building your wealth, as you know, it's about, if I can take tax dollars and permanent tax savings that's more money that I have to invest in the next project.
Right.
That's just our single biggest expense every year. Whether you're an employee and you're paying Social Security, Medicare, and your income tax, that is your biggest expense all year long. And if you can make a small dent in that then keeps that money in your thing that could reinvest somewhere else, man, that just makes me build my wealth exponentially faster. Right.
Well, I think, we're talking about depreciation benefits and everything.
Yeah.
I mean, for that money that gets invested, if you're able to maximize that can add 3-4% to your total return, right?
Totally agree.
Which is significant, and that's not always looked at. They just look at this is the deal, this is what I got. You didn't add back in what those tax benefits were.
Right. I mean, client building, they bought an $8 million apartment complex, right? Then with the bonus depreciation, when it was 100%, they're talking about the new bill to be back up to 100%. I mean, understand they financed most of that, but they get a deduction based on the $8 million, right? So, I mean, They really paid no tax for several years because of the depreciation and the cost segregation. They paid no tax for many years. So, I mean, that kind of taking advantage of that. And then think about that. All that tax they didn't pay, they now can invest and build that wealth just faster. It's just a phenomenal idea. But like I said, just getting competent help, getting with someone that knows what they're doing, and making sure you're doing it all the right way, set up the right way. And because, like I said, there are advantages out there. You just didn't take advantage of why you can.
So my takeaway from this conversation is that, real estate does provide a tremendous amount of tax benefits, but you need to make sure that you're maximizing everything that's available.
Yes, exactly right. And making sure it fits. Sometimes that idea that you have to change your tax, you have to change your facts a little bit. And so can you change your facts in a way that's going to make it more tax advantageous for you? And that's where you're getting that competent CPA or someone's going to help you walk through that and make sure you're getting just to the right place you want to be.
Awesome. Scott Snow with Provision. Thank you so much, because, especially nowadays, I mean, tax, and the more and more wealth you create, the more that you need to offset those tax.
Yeah.
And so this has been extremely helpful. And so thanks for being on the show.
Thanks for having me, DJ.